What happens to USO with this reverse split that starts trading on Wednesday, April 29th? And we can talk about what happens to your stock as well as your options. And then let's take a quick look at UCO as a relative comparison, and then you'll be able to see how this is going to trade. But looking longer term, you can see this stock has traded a high of almost 120 and just traded 230 last week. I'm showing you this is a quarterly candlestick chart over the last more than a decade. This kind of shows you where this thing has gone most of the time. Now don't be confused by or misled by this scale. This scale makes it look like it's kind of been flattish, but it really hasn't been. If we just go down in here, does this look flat to you? It does, right? Let's just go back from here, which is kind of the top of the range. Let's just look at that. What you see is this thing used to be trading at 20, and now it's trading at 2. So 20 to 2, that's 90% decline over the last 5 years. 90% down is not a good idea. It's not the kind of investment you want to be looking at. And again, this is an ETF, it's not a stock. So it's basically, it was the front month futures contract on WTI oil, and they're now reconfiguring it, and they're going to be investing in all types of things. They're going to do whatever they have to do to keep this thing from going all the way to zero itself. So they're going to do a reverse split. It's going to be 8 for 1, which means for every 100 shares that you have today, you end up with 12.5 shares. And the odd lots, I believe they're supposed to settle those with cash. And so what happens to your options on a reverse split? Well, what's going to happen is if we look in here, you're going to end up with 2 different contracts. Now, 8 for 1 on the stock means if it's 250, the stock could be trading at 20. And if it's an option contract, then what you're going to see is your strike will stay where it is. It'll be like a 2 strike. And then they'll issue new options, and those that were 2s will become 20s. And a 2.5 will become a 20 strike. And that'll look like a normal option like these. But what you're going to see here is this is going to be 12.5/100, which means that when you exercise the option, you're not going to get 100 shares anymore. You're going to end up with 12.5 shares, right? Because this is an 8 for 1 split, and that adds up to 12.5. So you'll be entitled to 12.5 shares, or you'll be selling it, depending on whether you have a call or a put. So that's what's going to happen. You're still going to have the same number of contracts, but the conversion into underlying equity will change to 12.5 divided by 100. That's what you're going to get. Instead of 100 shares, you're going to get 12.5 shares. So what's that going to look like? If we want to see what that looks like, we can go over to UCO, who just did a 25 to 1 split. And here you'll see 25 to 1 works out to 4 divided by 100. And they get to keep their strikes the same. But when you look up here, you can see the new contracts are trading up here. So they have the current at the money market, which is standard option contract, 100 shares conversion into, and then the 4 divided by 100 conversion. Strike price is where it was, number of contracts is where it was, but you then convert it into, and you end up with 4 shares instead of 100 for that contract. So that's what's going to happen with it. Everything's going to remain the same, but the conversion into the underlying equity will change to reflect the reality of the situation. Fundamentally, it doesn't change anything. It's just a reverse stock split. But what we know over time is unless the number of shares shrinks dramatically and there's a short squeeze, if there's not a short squeeze, then typically the contracts will just kind of drift back down again. And so in terms of return on investment, just to kind of give you a bit of line of sight of what's happened between these 2 contracts. UCO, that contract over the since its inception back in 2010, if you invested $10,000 in there, it'd be worth $12 today. So you're down 99.88%, and your average annual total return is you're down almost 50% a year. When you look at USO, since 2010. So both of these are 10-year returns. 10,000 would be worth $636. Your total return is you're down 93%, and your average annual total returns per year is you're down about 25%. That's the impact of a reverse split, an 8-to-1 reverse split. It starts trading on Wednesday, April 29th.